Hi everyone, this is your daily 10-minute business and finance news wrap for this Tuesday, the 30th of March 2021. I'm Ricardo Gonçalves. Later, we'll take a closer look at investing in technology and the world of digital disruptors. But first, to Queensland, and the state's tourism operators are facing another hit, with the latest snap lockdown to curb a growing COVID-19 cluster, crushing hopes of a bumper Easter holiday season. In 2019, before the COVID pandemic hit, Queensland welcomed 2.3 million domestic visitors over the month of April, and they spent a massive $1.4 billion. And last April, amid lockdowns, only 500,000 domestic tourists visited, spending under $200 million. That's down 90%. So what now? Earlier, Darren Mara spoke with Angela Jackson from Equity Economics.
Angela, first of all, your take on the effect this might have on the Queensland tourism sector.
Look, clearly it's going to be relatively significant. We're just coming into Easter and, the reports are 1 in 7 Australians was planning on heading to Queensland over the Easter period. Obviously, that was going to be a huge boost for the Queensland economy that has suffered, particularly due to that lack of international tourism throughout this period. So the impact of this lockdown is going to be significant on those operators.
Some 27,000 Queensland businesses have just come off JobKeeper as well, and a lot of those will have been in tourism. It's a double blow, isn't it?
Oh, look, certainly. And we're really entering, this new phase before the vaccine is fully rolled out, where businesses are going to have to cope with these possibly short, and let's hope it's a short lockdown, without that safety net of JobKeeper. It is going to hit businesses hard. It's going to hit workers hard as well, though, of course, because they're going to face lost hours and lost earnings. So the impacts of the economy will be quite broad. So even if businesses get through this just by shutting down and, cafes just don't operate, there are obviously workers who have therefore lost their wages.
What do we know about how significant the Easter long weekend is over, say, a fiscal year for a business in terms of revenue?
Look, it is going to depend. Obviously, for like Cadbury's, for example, it's a pretty big deal this time of year. So for certain retailers, it's incredibly important. So chocolate, shops, I think, but for others, school holidays are critically important. For the tourism industry, in particular for hospitality, we know that this is a critical period, probably, equal with Christmas in terms of families coming together, people moving around the country. So look, it is going to have a big impact on the Queensland economy. There's no doubt about that.
Might we expect some long-lasting impacts of this, even if it's just a 3-day lockdown, or worst case scenario, if it's extended over the weekend?
Not the problem, obviously, for tourism is that if you don't go on a holiday, you don't go on a holiday. So if you don't go, if people do not travel during the school holidays, they're not going to catch up that consumption. With the pandemic more broadly, you often find that sort of bounce back, if you like. You've seen that people maybe don't go out to so many restaurants, or maybe they don't buy as many things, but once things open up again, they're out, they're spending. With tourism and holidays, that's much more difficult. So yes, there will be some long-lasting impacts. And I think the real concern for the tourism industry in particular, this was always going to be a difficult period until international borders open up. This is the last thing they need at the start of that.
Angela Jackson there speaking with Darren Mara. Okay, let's take a look at house prices and who is to blame, or what is to blame for rising house prices. Well, the CEO of Westpac, Peter King, says it is a supply versus demand issue. He spoke at a financial review banking summit today, where he also added that inequality created by record low interest rates will need to be addressed by policymakers in the very near future. However, he blames a lack of supply as a major contributor to surging prices, noting more housing sales than new listings. Here he is speaking briefly at the Financial Review Banking Summit.
To me, if you've got a supply-demand issue, then let's look at how we can create supply. You could do that by more building. You could do that by expanding the regions. So if we can make it quicker to get from the regions to the cities, or in a post-COVID world, actually you don't need to, you can do it remotely. So I think there's different ways that we can solve it. Regional Australia and where we have the workforce will play a part of it. That's a more medium-term solution, but I think we can certainly look at those type of pieces. Trying to control prices through taxes and whatnot sometimes work, but not always. So you've got to think about those very thoughtfully before you go down that route.
Peter King, CEO of Westpac, there speaking at the Financial Review Banking Summit. To the Australian share market now, which fell 0.9% to 6,738 as bond yields continue to rise. There were losses across the board in the miners, BHP, Fortescue and Rio down more than 2%. The banks were mixed. NAB fell nearly 1% despite the ACCC approving its acquisition of Neobank 86400. Telstra was a bright spot, up 1.2%, and AGL fell 3.5%. That's despite some news from it. It is undergoing a major structural separation amid growing customer and community desires to tackle climate change, splitting into two. New AGL, which will provide electricity, gas, internet and mobile services to more than 30% of Aussie households, and plans to target full carbon neutrality. Its coal assets will be lumped in a company called Primeco, becoming the nation's largest generator, accounting for 20% of national electricity market supply. So for more on that and the rest of the day's market action, I spoke earlier with Alex Pollak from Loftus Peak. Alex, the big corporate story of the day here in Australia is that of Agile Energy essentially splitting into two, putting one business that has its retail assets, but another with its coal-related assets. What do you think that's all about?
Well, Richard, that's part of a global thing that's going on right now. I mean, you should see it in the context of what's happening with the big oil and the big energy companies globally, and they are aware of the fact that cars are going increasingly electric, and that the more cars go electric, the less oil is going to be required. Remember, 60% of oil is for transportation, and so they are moving towards. And I'm talking about BP and Exxon and Chevron and Total and Shell. They are moving increasingly and very fast towards a renewable-backed energy economy themselves. They are trying to put on as much wind and solar as they can to replace the oil, which they see as, less and less useful as cars increasingly go electric. And, that's point one. Point two, obviously AGL is also got this ESG thing going on, by which I mean investors in Australia want companies that are not sourcing energy from dirty sources such as coal, and so they would prefer to have a clean energy provider rather than one that's not. And so AGL is kind of just answering that question about making itself more investable by allowing the ESG component, the ethical investors, if you like, be able to buy AGL without having to worry about the coal parts of it.
Let's talk about more broader market themes, right? You're all about technology and disruption, but tech stocks have really been hit hard of late after having a spectacular 2020, right? But that's as bond market prices in higher long-term interest rates. So how are you playing this?
Well, we haven't. We've done quite well over the last 12 months, and we've had some degree of correction, about 10% in the last couple of months. But we are very careful about the kinds of, we like to think of not so much as technology, but we are involved in disruptive companies. And we're very careful when we invest in them, we buy the stuff with the best balance sheets and the best cash flow. And so, of course, we own Amazon and Apple and Alibaba, but also a number of really important tech stocks out there, such as Qualcomm, John Deere. Increasingly, the farm equipment provider is increasingly, enabling farmers to have knowledge of the quality of their soil into which they're planting, etc. So we make sure that we buy the companies that have good balance sheets and good value propositions and are not hurt in the event that interest rates go up a bit.
And right now, in this current environment, where do you see the opportunities?
Well, there's a global thing going on, which is industry is moving its IT departments to the cloud. I mean, that is 96% of IT spending right now is not on premises, by which I mean it's focused on cloud and infrastructure. And if you go back 10 years ago, it was the other way around. 96% of IT spending was actually on the premises for the big for big corporations globally. that movement to the cloud doesn't mean that they're any less dependent on technology. It just means that the architecture of the technology that they're involved in is less and less domiciled in their premises and more domiciled in data centers and as I say, the cloud and the edge, so to speak. And so we are very focused on investing in the companies that are providing those data center and cloud infrastructure businesses. And that's kind of was what underpinned our results over the last 12 months and prevents us from being hit by, the specky stuff, buying the hottest electric car company and then having it fall 30%. So we're not in that category, right? So that's what we see as important right now. So again, companies like Microsoft are very interesting for their cloud business. Companies like Alibaba are very interested for their cloud business. Companies like Amazon are very interesting for their cloud business. Amazon in particular is more interesting for the cloud business than it is for the retail itself. Everybody focuses on the retail, but the cloud business is a bigger provider of earnings than the retail business inside Amazon. So that's a very important company for us.
Alex Pollak there from Loftus Peak. That is SBS On The Money for this Tuesday, the 30th of March 2021. I'm Ricardo Gonçalves. You can follow me on Twitter and Instagram at Business Ricardo. This On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.